Welcome to The Explainer. Today, we are taking a seriously cinematic journey together to demystify the share market. We're going to trace its 400-year history, moving step by step to uncover exactly how this massive global financial engine actually works.
So what do 17th century pirate-filled waters have to do with your savings? I know it sounds like a crazy movie plot, but this is the very real origin of global finance. Okay, let's dive into this and uncover the absolutely fascinating connection between ancient oceans and your modern wealth.
Here's our quick roadmap for today. We'll start with the origins of the share market, dissect primary versus secondary markets, track the market's pulse, navigate modern investing, and finally, contrast trading with long-term investing.
Chapter 1. Origins of the Share Market, from Ships to Stocks.
To really understand the complex, lightning-fast digital exchanges of today, we actually have to travel back about 400 years. Picture this, it's the 1600s, and the world map is still largely a total mystery. Companies like the Dutch East India Company wanted to send these massive wooden ships thousands of kilometers across the globe to discover new lands and trade for exotic treasures. But here's the catch. Funding a ship like that was incredibly expensive, and nobody just had that kind of cash lying around. Plus, it was unbelievably dangerous. We're talking more than half of these ships never returning. They sank, got lost, or were literally looted by pirates. So to mitigate this massive risk, they came up with a genius idea. They publicly invited regular people down at the docks to fund not just one ship, but multiple ships. Think about it, if you funded 5 or 6 ships, even if 3 of them sank, the ones that did return with treasure would make you rich. This open bidding at the docks to share the risk and the reward was the birth of the primitive share market.
Let's bring this concept a little closer to home on a much smaller scale. Imagine you want to start a brand new business. You've got 10,000 rupees, but you actually need 20,000 to get it off the ground. So you go to a friend and say, hey, invest 10,000 rupees with me and I'll give you a 50-50 partnership. Now, if the business makes a profit down the line, 50% is yours and 50% is your friend's. But if it tanks and incurs a loss, well, you share that too. You've effectively given 50% of your company's shares to your friend.
And that beautifully illustrates what a share fundamentally is. A share is simply a percentage of ownership in a company. When a company wants to scale up massively, it doesn't just go to one friend, right? It invites the entire world to buy these percentages of ownership. You literally become a part owner of that business. It's pretty cool when you think about it.
Moving on to Chapter 2, Primary versus Secondary Markets. Who sets the price?
So now that we know what a share is, where do these things actually live and breathe? Well, it all starts with the primary market. When a company decides to sell its shares to the public for the very first time, this is called an initial public offering, or IPO. In the primary market, the company itself is the one doing the selling. Based on its total valuation and how much public demand there is, the company gets to decide the exact price range and the total number of shares it wants to issue.
But here is a super critical detail to remember. Companies almost never sell 100% of their shares during an IPO. Why? Because shares equal decision-making power. If you sell all your shares, the public completely owns and controls your company. This is exactly why founders retain majority ownership. Keeping over 50% ensures the founder stays the boss. For example, Mark Zuckerberg famously retained roughly 60% of Facebook's voting shares just to maintain control, while the rest was offered up to public shareholders.
So, the crucial takeaway here is the sharp difference between these two environments. In the primary market, you buy directly from the company, and the company sets the initial price. But once those shares are bought, people naturally want to buy and sell them among themselves. This happens in the secondary market. And here is the kicker. Once shares enter that secondary market, the company can no longer control the price. The price fluctuates entirely based on human behavior. It's completely driven by the demand and supply from investors trading with each other.
Chapter 3. Tracking the Market's Pulse, Sensex and Nifty.
With all this frantic buying and selling going on every second, how do we actually know if the overall market is doing well? Well, the first big challenge is just the sheer scale of the market. In India, there are 2 massive stock exchanges. The Bombay Stock Exchange, or BSE, has around 5,400 registered companies. The National Stock Exchange, or NSE, has around 1,700. I mean, it is physically impossible to track the daily performance of thousands of companies individually just to figure out the general mood of the economy.
So to solve this problem, we use specific measurements, or indices, that act kind of like a thermometer for the market. The Sensex, which stands for Sensitivity Index, averages out the performance of the top 30 companies on the BSE. Nifty, which cleverly stands for National Plus 50, tracks the top 50 companies on the NSE. By just looking at how the absolute biggest players are doing, we get a highly accurate summary of the broader market trend.
You'll often hear news anchors yelling excitedly about the Sensex hitting new heights, right? Like crossing the 40,000 mark. But honestly, that number by itself doesn't mean much until you look at the history behind it. Decades ago, the index was given a randomly decided starting baseline value, say 100 or 500. The fact that the Sensex reached the 40,000 mark over 50 years demonstrates the massive historical growth of those top companies compared to that initial humble starting point.
Chapter 4. Investing in the Modern Era, Accounts and Regulations.
So the market has grown tremendously, but how do you actually get involved safely? Back in those East India Company days, literally anyone could ask for money at the docks. That meant it was incredibly easy to scam people with totally fake companies. And unfortunately, even in modern times, markets have been rocked by massive frauds, like the infamous Harshad Mehta or Satyam scams. To make the market scam-proof today, the Security and Exchange Board of India, or SEBI, enforces incredibly strict rules. To list a company now, you need at least 2 independent auditors, you must already have over 50 shareholders, and the rigorous checking process can take up to 3 solid years. The barrier to entry is high, but that's intentionally designed to keep retail investors like us safe.
And thankfully, participation itself has never been more streamlined. Before the internet, you actually had to physically go to the Bombay Stock Exchange building to trade. Today, you just need a simple trio of accounts. First, a bank account to hold your actual money. Second, a trading account, which acts as your interface to execute the buying and selling. And third, a demat account, which is basically a digital vault that safely stores the electronic shares you've purchased.
But how does all this build into your actual profits? Well, since you can't walk onto the exchange floor yourself, you need a broker to connect you to sellers. And naturally, brokers charge a fee. Traditional bank brokers might charge around 1% per transaction. Now that sounds small, but it's actually quite high and can seriously eat away at your profits over time. Modern digital platforms and apps have thankfully slashed this, often charging just 0.05% to 0.10%. Understanding these fees is absolutely crucial, especially depending on how often you plan to buy and sell.
Which brings us to our final section, Chapter 5, Trading versus Long-Term Investing, Time is Money. So, how often should you buy and sell? You really need to clearly distinguish between these two completely different strategies. Day trading is effectively a full-time job. Traders are glued to their screens, rapidly putting money in and pulling it out of different shares in quick succession to capture tiny short-term price movements. Because they make so many transactions, those high brokerage fees we just talked about will literally destroy their profits. Long-term investing, however, is buying a share because you genuinely believe in the company and just letting it sit and grow over years. For long-term investors, that initial brokerage fee matters much less because, well, you're only paying it once.
But a quick word of caution. As our source material wisely points out, if you are not aware of the company's performance, history, and accounting, then this is akin to gambling. Direct investing carries significant risk for novices. You should never, ever just blindly invest in a stock because you heard a rumor from a friend that it's doing well. Without real financial knowledge, picking single stocks yourself is incredibly dangerous. So what is the smart alternative for most of us? Mutual funds. A mutual fund simply means you pool your money together with others and hand it over to financial experts. These experts then diversify the investment across many different companies. It ties beautifully back to our 1600s metaphor, right? Investing in a mutual fund today is exactly like those smart doc investors funding 5 or 6 ships at once instead of risking all their treasure on a single unpredictable voyage. Which leaves us with the ultimate question for your own financial strategy. As you look toward your future, will you gamble on a single ship or will you invest in the whole fleet? Take the time to understand the markets, assess your risk, and make the choice that builds your lasting wealth. Thank you so much for joining me on this explainer, and I will see you in the next one.